Hello, grade 11s. We are going to be starting a new section on manufacturing, and so I've decided to make this video to try and just explain it, or the basics of it, the foundational elements of it, as clearly as I can, hopefully. And then if you need to, you can come back to this video to review it. All right, let's try. I'm just going to make this smaller, like this. I don't actually know what you're seeing. I don't really know this program very well. Let's go here. Okay, hopefully you are now seeing my paint screen. Or are you actually? I'm not sure. I think so. What if I go screen capture? I don't know. I'm sure it'll be fine. Unfortunately, I forgot my little writing pad, so I'm just going to use my mouse, and we'll see how that goes. Okay, so the first thing I need to tell you is that usually we buy trading stock. That's what you're used to. But now, instead of buying trading stock, we're going to make our own stock. We're going to call that finished goods stock. Finished goods, because when you're making it and it's finished, we can call it finished goods. That is your trading stock figure, okay? In manufacturing. So manufacturing, everything, well, the thing we're focusing on in manufacturing is how do we produce this quote-unquote finished goods stock figure, which is the trading stock figure for in manufacturing. So when you produce it, you are going to need some raw materials. So let's start there. Raw materials. However, the raw materials that we use have a direct relationship with the number of units produced. That is to say, the more units you produce, the more raw materials you will use, and vice versa, and opposite. That is, the less units you produce, the fewer units you produce, the less materials you will use. And therefore, we can call raw materials, more accurately, direct materials. Direct materials. There is another direct cost that we have to also consider when producing a good. And that is the people that work on the production line, the people that work in the factory on the production line, the people that are taking the raw materials and putting it in the machine, or who are taking the units off and putting them in boxes, or whatever it is. The people that work on the production line, where you need more of them if you produce more goods and fewer of them if you produce less goods, that labor is called direct labor, because they too, the amount of this cost also varies with number of units produced. So any materials or labor that varies directly with number of units produced is called direct materials and direct labor. But those are not the only costs that go into producing a good. We also have what are called factory overhead costs. An overhead is a cost that is not directly related to the number of units produced. It might change with number of units produced, but not directly. Let me give you some examples. Factory overhead costs are things like, why can't I, oh, what have I done? Are things like nothing. I can't type. Why can't I type? Well, that's weird. Let me just start a new thing. There you go. Factory overhead costs are things like insurance on your factory, on your machines and your building. Rent. You have to pay rent on your factory, right? Indirect materials. Things like, soap for cleaning the factory and oil to oil the machines. These costs are not, they don't go up and down directly with the number of units produced. You cannot say, I use exactly 5 milliliters of lubricating oil per unit that I produce. No, it's just, oh, the machines need to be oiled, let's do it. Oil the machines. And so it is used in the running of the factory and the producing of the goods, but it does not change directly with the number of units produced. And likewise, there is also indirect labor. Things like cleaners and managers. The management of the staff are not there working with the goods. You don't have to hire more management if you're going to produce more goods. The line manager you'll still use one line manager whether you have 5 workers on the production line or 7 workers on the production line. You will still only have one line manager whether you have 4 workers working for 6 hours or 4 workers working for 8 hours. So the line manager and the cleaning staff, they are examples of indirect labor. You need them in the factory, but the number of them that you need does not go up and down directly with the number of units produced. What else? We've got water and electricity. Yes, water and electricity will go up and down with electricity. Water and electricity will go up and down with number of units produced. But there are other things that require water and electricity, like when the staff have to go and use the bathroom and then they run the taps and flush the toilets, or the lights in the warehouse and the running of the vacuum cleaners and what I don't know whatever is used in the factory that is not directly for the producing of the good. We cannot say exactly how much water and electricity we are using per good, and per unit being produced, and therefore it is a factory overhead cost. What else? We've got depreciation, and so on. There are a few. I just want to make sure that I am still, yes, both of my microphone sides are still working. It's hard to explain. There's something wrong with my microphone. So, now that we have our direct material cost, our direct labor cost, and our factory overhead cost, we can now work out the finished good cost? No, not yet. First, we can work out our work in progress, or let me use hyphens here, work in progress amount. That is how many partially completed units have we produced this year. And then, once we have completed, how do I say this? I will explain how. But at a certain point, you say, okay, this is how much work in progress became finished goods stock. And so then you have finished goods stock. Okay. So we had raw materials, direct labor, and factory overhead costs. And those produce works in progress. And then some of that work in progress becomes finished goods stock. And I'm about to explain why not all of it becomes finished goods stock. But in order to explain that, I need to explain the fact that we have 2 different types of accounts here. We have some expenses and we have some assets. Direct materials is an asset. Direct labor, expense. Insurance, asset. Rent, what did I say? Asset, come on. Insurance, expense. Rent, expense. Indirect materials, asset. Indirect labor, expense. Expense. And work in progress is an asset. Finished goods stock is an asset. And so, So we've got 4 assets here: direct materials, indirect materials, works in progress, and finished goods stock. Why is that important? Well, it is important because we have opening and closing balances of these items. Any asset has an amount that you start the period with and an amount that you end the period with. Now, because of the principle of first in, first out, first in, first out, whatever materials we bought first, we will use first. Whatever works in progress we produce first will become finished goods stock first, and so on. First in, first out. Therefore, because of first in, first out, whatever goods we started, or whatever asset we start the year with, we use first. And so we can assume that included in, let's say, the work in progress included in the work in progress amount that we produce is the opening stock for the direct materials. And what's not included in the work in progress amount is the direct materials that we ended the year with, right? Because if we ended the year with those direct materials, it means we didn't use them, right? We first used the materials that were left over from last year, and we did not use the materials that were left over at the end of the year. So direct materials has an opening and a closing balance, and we have to consider those. And indirect materials have an opening and a closing balance, and we have to consider those. That is, we have to add the opening balance of indirect materials and minus the closing balance of the indirect materials. And similarly, when we get to works in progress, we have some works in progress at the beginning of the year, and we have some works in progress left over at the end of the year. So, just like with direct materials and indirect materials, we would have to take the work in progress for the year, that is the works in progress that we produced this year, add the works in progress at the beginning of the year, minus the work in progress at the end of the year, so let's say add and minus, and that will then give you your finished goods stock. Let's do that a little bit nicer. No, that still looks terrible. Anyways, work in progress produced during the year, plus your work in progress at the beginning, minus your work in progress at the end, and that will give you your finished goods stock. Now, if you understand this process, then we have a good foundation. The process that direct materials, direct labor, and factory overhead costs together make work in progress. And that work in progress becomes finished goods stock. Then, if you understand that, then we have a good foundation. However, what you are going to, the format in which you are going to manage this flow of goods and services, not services, well, I suppose, because labor is a service. This flow, this production process, you are going to manage it using T accounts. You know T accounts from the general ledger. You've done a million of them. Well, we have T accounts for manufacturing as well. I mean, all of these things, rent, direct labor, depreciation, these are all accounts in your general ledger. So, as you've done before, we are going to have to put these materials into the T accounts. Let me give you a couple of examples. Let's use the factory overhead costs. I hope you don't mind if I abbreviate it into FOC. We have our work in progress. I hope you don't mind if I abbreviate that to WIP, works in progress. And we have finished goods stock. Again, I'm going to abbreviate it, FGS. So we've got factory overhead costs, works in progress, finished goods stock. Now, you know that more goes into works in progress than just the finished goods stock. There's other things as well, direct labor and direct materials. But for this example, we're just going to focus on the the factory overhead stock. So we have an amount that goes into our factory overhead cost for this year. We're going to do it like a triangle. Then, at the end of the financial year, we've now calculated all of our factory overhead costs. We then take those factory overhead costs out and put them into our work in progress account. Then, once we've looked at the work in progress for the year, plus the work in progress at the beginning that we started the year with, minus the work in progress that we ended the year with, now we will have some amount of work in progress that can go to the finished goods stock account. Do you see? There is stuff going in, stuff going out. Out of factory overhead costs into works in progress. Out of works in progress and into finished goods stock. Okay. And so what we're going to look at is how, what we are going to get used to is how to record the information like 4,000 rands worth of insurance and 10,000 rands worth of raw materials in these T accounts. And that is the focus for grade 11. So I hope this was helpful. This is now our starting point, our foundational knowledge, and we can go from here into hopefully some examples. Okay, that's it from me, and goodbye.